The air of optimism that once buoyed the nation's economic prospects has given way to a gnawing sense of unease. As fresh inflation data landed with a resounding thud, it cemented a sobering reality: the Federal Reserve's battle against rising prices is far from over, and the path ahead is shrouded in uncertainty. On Friday, the government released its latest inflation figures, and the news was far from reassuring. The Fed's preferred gauge of underlying inflation, the Core Personal Consumption Expenditures Price Index, climbed 0.3% in March and a staggering 2.8% from a year earlier, matching the prior month's concerning levels. Even more unsettling, earlier data was revised upward, casting a pall over the already gloomy outlook. These 3 consecutive months of worrisome inflation data have effectively stalled progress toward the central bank's long-standing 2% goal. The implications are profound. Any hopes of an imminent interest rate cut are rapidly receding into the distance. Investors, who had anticipated 1 or 2 rate cuts this year, beginning as early as November, now face the disquieting prospect that the Fed may not lower borrowing costs at all in 2024. The hot inflation readings through March should write off any rate cuts in the first half of 2024, warned Ben Ayers, senior economist at Nationwide. There is also a risk that the further economic resilience pushes off any rate declines until 2025, a key downside risk for growth next year. Ironically, the very strength of the U.S. economy, which should be a source of pride, has become a double-edged sword. The government data released on Friday underscored the nation's economic vigor, with inflation-adjusted consumer spending growing a robust 0.5% for a second consecutive month in March, matching the strongest advance since the start of 2023. This economic resilience, however, comes at a cost. The previous day's release of quarterly figures for the Core Personal Consumption Expenditures Price Index, which excludes the volatile food and energy components, exceeded forecasts, sparking concerns that the March advance would prove even stronger than anticipated. They are willing to sit tight for now because they see policy as already restrictive, observed Kathy Jones, chief fixed-income strategist at Charles Schwab. But after Thursday's report, I think it's a relief to them that it wasn't higher. As the Federal Reserve prepares for its next meeting next week, it is widely expected to hold rates at their current, more than 2-decade high. Policymakers will not release updated projections until their gathering in June, but the writing is on the wall. The median official may no longer anticipate 3 cuts this year, as they did in their March rate forecasts, known as the dot plot. The balance of risks have shifted squarely to the upside on inflation, cautioned Derek Tang, an economist with LH Meyer/Monetary Policy Analytics. Compared to the March dots, officials are likely projecting at least 1 fewer cut this year, which means starting later. Fed Chair Jerome Powell's recent remarks have only reinforced this hardline stance. Last week, he declared that the central bank was prepared to keep policy restrictive as long as needed if price pressures persist, a sentiment that is likely to echo through the halls of the Fed's next meeting. The Fed will inevitably sound more hawkish next week than it did in March, predicted James Knightley, chief international economist at ING. They will still talk of an anticipated moderation, but acknowledge that they really need to see that over a number of months before they can relax. As the nation grapples with this sobering economic reality, the weight of the Fed's actions falls squarely on the shoulders of ordinary Americans. For those long concerned about financial development and those professionally engaged in financial-related work, the path ahead is fraught with uncertainty. The once hopeful prospect of relief from soaring costs and high interest rates now seems like a distant mirage, obscured by the harsh realities of persistent inflation and an unyielding central bank. As the nation holds its collective breath, the question lingers: how long can the Fed hold its restrictive stance before the economic landscape shifts once more?